Debt and equity are two key ways to raise money in finance. Both help fund projects, expand businesses, and create opportunities, but they work in very different ways. Debt means borrowing money that must be repaid with interest. It creates a financial obligation but allows the borrower to keep full ownership of the business. Equity, on the other hand, means selling a part of ownership in exchange for funds. Investors who buy equity share profits and risks but gain voting rights in the company. When a company takes on debt, it borrows from banks or investors through loans or bonds. The debt must be repaid on time regardless of profits or losses. Equity funding comes from shareholders or venture capitalists. There's no repayment pressure, but profits must be shared as dividends or reinvested for growth. Debt is cheaper in the short term because interest is tax deductible, but too much borrowing can strain cash flow and increase financial risk. Equity is safer since there's no repayment, but it dilutes ownership and can reduce the founder's control over business decisions. For businesses, striking the right balance between debt and equity is crucial. This mix is called the capital structure. Too much debt can lead to financial instability, while too much equity can slow decision-making and reduce earnings per share. Investors see debt as a safer bet with fixed returns, like bonds. Equity, however, offers higher potential returns but carries more risk. In strong markets, equity performs well because profits rise and stock prices increase. During uncertainty, debt investments provide steady income. Startups often prefer equity funding to avoid repayment burdens, while mature companies use debt to fuel expansion without giving up control. A company's choice between debt and equity depends on its goals, risk tolerance, and stage of growth. It's never one size fits all. Financial managers carefully assess cash flows, interest rates, and investor sentiment before choosing the right funding mix. A balanced approach ensures stability, debt for growth efficiency, and equity for long-term resilience. Together, they sustain a company's financial health. In the end, the real winner isn't debt or equity alone, it's how smartly they're combined. Balance, strategy, and timing define true financial success.